not all debt is created equal. You've probably heard someone say all debt is bad, usually someone older, maybe a parent or a Dave Ramsey fan. You've also probably heard the opposite: you need to use other people's money to build wealth, usually from a real estate investor or someone trying to sell you a course. Both of those takes are incomplete. The truth is somewhere in between, and it's actually pretty nuanced. Understanding the difference between good debt and bad debt is one of the most important frameworks in personal finance. Get it right and you can use debt as a tool to build wealth. Get it wrong and debt can quietly drain your finances for years. Let's break it down clearly. The distinction between good and bad debt comes down to a few key questions. First, does the debt help you acquire an asset that increases in value or generates income? Good debt funds things that grow in value: a home, a rental property, a college degree that leads to significantly higher earnings. Bad debt funds things that lose value or generate nothing: a vacation, restaurant meals on a credit card, impulse purchases. Second, what is the interest rate? Good debt typically comes with low interest rates, mortgage rates, federal student loan rates, sometimes business loan rates. Bad debt comes with high interest rates, credit card APRs averaging around 20%, buy now pay later schemes, payday loans at hundreds of percent annually. At high enough interest rates, no asset appreciates fast enough to justify the borrowing cost. Third, does it improve your earning capacity? A student loan for a degree that significantly increases your income over a career can be good debt. The same loan for a degree with poor job market outcomes is arguably bad debt regardless of the interest rate. Here's a cleaner way to think about it: good debt is an investment in your future self that generates a positive return above the cost of borrowing. Bad debt is paying tomorrow for something you consume today, with interest. Let's go through the most common examples of debt that can be genuinely good, with important caveats. A mortgage is the classic example of good debt. You're borrowing to purchase an asset, real estate, that historically appreciates over time. You're also locking in a monthly housing cost instead of being exposed to rent inflation. And mortgage interest is partially tax deductible. The caveat: this only works if you can actually afford the payment without stretching yourself dangerously thin, and if you plan to stay long enough to offset transaction costs. Student loans are often cited as good debt, but they're the most nuanced category. A federal student loan at a 6% interest rate for a nursing degree, engineering degree, or computer science degree, where median salaries are $80,000 to $120,000, can make enormous sense. The math works. But student loans for degrees with poor return on investment, when the degree doesn't meaningfully boost your earning power, function much more like bad debt. The key is calculating the expected income increase versus the total debt burden. Business loans for a viable business are typically good debt. You're borrowing capital to deploy in a way that generates returns greater than the interest cost. If you borrow $30,000 at 7% to purchase equipment that allows your business to generate an additional $50,000 a year, that's a clear positive trade. Auto loans can be borderline. A car is a depreciating asset; it loses value the moment you drive it off the lot. But if you need a car to work, and the interest rate is low, a modest car loan is often acceptable. The mistake is borrowing at high rates for a car you can't afford, treating a depreciating asset like an investment. Credit card debt is the clearest example of bad debt for most people. The average credit card APR in the United States right now is around 21 to 22%. That means if you carry a $1,000 balance on a credit card, you're paying over $200 a year just in interest, for nothing. You're not acquiring an asset, you're not increasing your earning power, you're just paying the bank to let you spend money you didn't have. The insidious thing about credit card debt is how quickly it compounds. Someone who carries $5,000 in credit card debt at 20% APR and only makes minimum payments will take years to pay it off and pay thousands in interest, far more than whatever they originally purchased. Buy now pay later services like Klarna, Afterpay, and similar products seem convenient, but they're engineered to get you to spend more than you would otherwise. When they charge interest, which many do after a promotional period, rates can be very high. Payday loans are the worst financial product in the consumer market. Annual percentage rates routinely reach 300 to 400%. People take them in desperation and find themselves in a debt trap that's extremely hard to escape. Personal loans for consumption, vacations, weddings, electronics, are bad debt not because the interest rate is necessarily terrible, but because you're borrowing to consume rather than to invest. You're not getting anything back that will help you repay it. Car title loans, predatory short-term lenders, all bad debt. These products target people in financial distress and often make situations significantly worse. The honest answer is that many debt situations fall into gray areas. Here are a few important ones. Medical debt is often unavoidable. You don't choose to need emergency surgery. But how you handle medical debt matters. Hospitals almost always have financial assistance programs and are often willing to negotiate. Medical debt under $500 was removed from credit reports in 2023. Don't put medical bills on a credit card without first negotiating directly with the hospital. Home equity loans and HELOCs, home equity lines of credit, are using your home as collateral to borrow money. This can be good debt if you're using it to improve the home, which increases its value, or for a genuinely productive purpose. It becomes bad debt if you're using your home equity to fund consumption, because now you're putting your house at risk. Student loans, as mentioned, are entirely context-dependent. The same loan amount can be excellent or terrible depending on the degree and the career outcome. Borrowing to invest in stocks or crypto is almost always bad in practice for retail investors, even though in theory leverage can increase returns. The problem is volatility. If markets drop 50% and you borrowed to invest, you may get a margin call and be forced to sell at the worst possible time, locking in losses. Here's a practical framework for evaluating any debt you have or are considering. Step 1. Write down every debt you have with the balance, interest rate, and minimum payment. Seeing them all together gives you clarity. Step 2. For each debt, ask these 3 questions. Is the interest rate above 8%? If yes, it needs to be paid off aggressively. Above 8%, almost nothing earns enough to justify carrying the debt. Is the debt funding something that appreciates or increases my income? If not, it's bad debt regardless of interest rate. And finally, am I able to make the payments comfortably without affecting my ability to save and invest? If no, the debt load is too heavy. Step 3. Prioritize payoff using either the avalanche method, highest interest rate first, or the snowball method, smallest balance first for psychological momentum. For high-interest bad debt, avalanche is mathematically superior. Step 4. Stop adding to bad debt. This sounds obvious, but it's often the hardest part. If you're carrying credit card debt at 20%, every new charge on that card is a 20% loan. And for good debt, be honest with yourself about whether it's actually good debt in your specific situation, not just in the abstract. Here's the most important thing I want you to take from this video. The goal is not to avoid all debt. The goal is to use debt strategically and intentionally. Some of the wealthiest people in the world carry debt, strategically borrowed at low rates against appreciating assets, while their investment portfolios earn more than the interest cost. That's called leverage, and it's a legitimate wealth-building tool when used correctly. But debt used to maintain a lifestyle you can't otherwise afford, that's a slow leak in your financial boat. Credit card debt in particular is one of the most reliable predictors of financial struggle. Not because people who carry it are irresponsible, but because the interest rates are structurally designed to be almost impossible to escape without focused effort. If you're carrying high-interest debt right now, paying it off is one of the best investments you can make. Eliminating a 20% interest debt is a guaranteed 20% return. No investment can reliably promise you that. And if you're considering taking on new debt, whether a mortgage, a student loan, a business loan, go through the questions. Does it build an asset? Is the rate reasonable? Will the return exceed the cost? If yes to all 3, it might be genuinely good debt. If not, proceed with extreme caution. Debt is a tool. Used well, it builds. Used poorly, it destroys. Now you know the difference.